Donald Trump has hiked India's tariff rate to 50% from 25% to punish it for buying oil from Russia. Markets are also wary of imminent Trump decisions on replacing key people at the Fed and at the Bureau of Labour Statistics. That's coming up in our 5 Things in 5 Minutes on Thursday, August the 7th. And in our deep dive interview, ANZ commodity strategist Sunny Kumari details India's huge need to import metal as it electrifies its economy.
Electric vehicles use 3 times more copper than internal combustion vehicle, and to build solar and wind infrastructure, it requires 4 to 5 times more metals compared to conventional power plants.
But first, in 5 and 5 with ANZ. Overnight, Donald Trump has hiked India's tariff rate to 50% from 25% to punish it for buying oil from Russia. The new rate is effective in 3 weeks' time. India's stock market fell, as did the Indian rupee, which was already near record lows in anticipation of this news. Here's ANZ economist in London, Bansi Madhavani, on the importance for India.
This additional 25% comes on the top of existing 25% reciprocal tariff on India, which was announced earlier last week. So at a combined 50%, the tariff rate on India is now the highest amongst US's major trade partners. It is also important to note that the 50% tariff rate on India is now higher than the one on China, which is currently around 30%. So if sustained on a relative basis, it does put India at a competitive disadvantage.
As of 4 a.m. Sydney Melbourne time, India's Nifty 50 stock index was down 0.6%, and the Indian rupee was near lows at 87.7 rupees to the dollar. The S&P 500 was up 0.7% and the Nasdaq up 1.2%. The US Treasury yield rose 4 basis points to 4.23%, the 10-year. Gold was steady at $3,431 an ounce, while West Texas oil futures fell a further 1.4% to $64.25 a barrel. The US dollar index was down about 0.5%, and the Aussie dollar was up by the same amount at 65.05 US cents. The Kiwi up 0.6% at 59.38 US cents. Number 2. Bansi says markets are also worried about a couple of other announcements Donald Trump has up his sleeve.
First, Fed Board Governor Adriana Kugler resigned last week. This resignation paves the way for Trump to fill the vacancy, and odds are that the new appointee would be a sympathizer of Trump's preference for lower rates. It is also likely that the appointee will be seen as a potential candidate for Chair Powell's role when his chairmanship ends in May 2026. The second appointment would be that of the Commissioner of Bureau of Labour Statistics. This follows President Trump's firing of the existing commissioner, citing concerns about data and the extent of revisions in the labour market report last week. Both these are closely watched for signs of where policy will be headed in the coming weeks.
Number 3. Before Trump's confirmation of the 50% tariff, the Reserve Bank of India decided to hold its key rates. ANZ economist Dhiraj Nim had expected a cut.
The key points that differed between our assessment and the RBI's assessment of the economy was the RBI seems to be quite sanguine on growth. They expect FY26 GDP growth at 6.5% and they see it at 6.6% in Q1 of FY27. We think that growth is going to be slower than that, given the external environment that is very challenging at the moment, the high US tariffs, especially on India, and some weakness in domestic demand indicators that has recently crept in.
Number 4. Dhiraj says the RBI may also be overestimating inflation.
Even on inflation, while the Reserve Bank of India cut their inflation outlook or inflation projection for FY26 average to 3.1% from 3.7% earlier, and they see Q1 FY27 inflation at 4.9%, which is a pretty elevated number, we think that inflation can still surprise the Reserve Bank of India on the downside. So our assessment is a bit more dovish as far as growth inflation mix for India goes than the RBI's. So they have continued with their neutral stance, and we have pushed out our rate cut to October now.
Number 5. New Zealand's unemployment rate edged up to 5.2% in the June quarter from 5.1% in the March quarter. But the underlying figures were softer than the headline suggested, especially the underutilisation rate rising to 12.8% from 12.4%. Here's ANZ New Zealand senior economist Miles Workman.
And at face value suggests that there's more economic spare capacity in the labour market than the headline unemployment rate implies. So I actually do think that relative to the Reserve Bank's forecast, there is a slightly mildly dovish tone in these data suggesting that pipeline disinflation progress will continue and that the labour market is well and truly in a disinflationary state.
Miles Workman there. Now, in part one of a deep dive interview, ANZ commodity strategist Sunny Kumari has researched the scale of India's needs for critical minerals as it electrifies its economy.
Clean energy technology are metal intensive than their fossil fuel based counterparts. And just to put into perspective, electric vehicles use 3 times more copper than internal combustion vehicle. And to build solar and wind infrastructure, it requires 4 to 5 times more metals compared to conventional power plants. So with target of 500 gigawatt of renewable energy by 2030, and which is likely to increase further by 2040. So the metal requirements are set to rise strongly. And we expect the total demand for metals like copper, aluminium, nickel, cobalt, and lithium together to increase 9 times from energy transition towards 6.2 million tons by 2040.
And can India supply enough of its metals for itself, or is it going to have to import from others?
Well, India is scarce in resources, especially for battery materials like lithium, cobalt, and nickel, where import dependence is 100%. So the country is only self-sufficient in aluminum right now. And very soon, I think we estimate by 2027, India will become a net importer of aluminum if domestic production is not expanding. So increasing demand from energy transition as well as economic expansion will see a strong demand growth for metals, and domestic supply will not be enough to cater this demand surge. As a result, we'll see import dependency is set to increase. And the problem is not just domestic supply shortfall, but the concentration of these metals is a global problem. Just to provide, some numbers, the top 5 producer accounts for 60 to 90% of the global output for these metals and critical minerals. So such reliance amplifies the supply chain risk from political, trade, and also environmental events. And with emerging export controls in the current geopolitical environment, security for battery material supply is at risk, especially as the whole world is accelerating towards an energy transition.
What types of metals are most in demand, and why is that?
Major metals like copper and aluminum, and battery materials like nickel, lithium, and cobalt. So demand for these all metals will see a double-digit annual growth through 2040. Like for power sector, where we see demand mainly coming from solar and wind, along with grid transmission expansion. So here, copper and aluminum will be used largely, and demand is likely to increase 3 times by 2040 from this green power infrastructure. The other area is battery storage, which is still in initial stage in India, but government is planning to expand battery storage many times. Like the target is 42 gigawatt, but we are expecting the realistic target will be 24 gigawatts. So the demand from these battery storage for these critical minerals is also going to increase. And the other sector, which is very important and which is likely to contribute more than 50% of the total demand for metals coming from energy transition, is the electrification of the transport, where all the metals will be required, like copper, aluminum, and all the battery materials.
Sunny Kumari there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, August the 7th. Catch you tomorrow with part 2 of Sunny's deep dive interview on the opportunities for Australian mining exports as India scrambles to get its hands on these critical minerals. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.